Welcome back. Well, that initial dip has got bought into, so the markets have recovered close to around 50 points from the low point of the day. That's the Nifty itself. The mid-cap index is as flat as can be. And take a look at the insurance stocks. HDFC Life, well, that's moved to the high point of the day. It opened up in the red. It's moved higher. HUL, that's another heavier weight stock. That as well has done pretty well. And two of them, ITC and Reliance, they have recovered. That's what's helping us trade with some green. But let's focus on a couple of other companies then. Consumer electronics space in particular has been in focus. Select channel checks, well, they suggest that the industry has seen some weakening of demand in the recent past. To discuss this, get a check on the ground, well, we're joined by Mr. Anuj Podar, the MD and CEO at Bajaj Electric. Hi, Anuj. Good morning. Thanks so much for joining in. Wishing you and your team a rocking 2023. Select brokerages, they are suggesting that there's been a slowdown of demand. Could you tell us, is that what you're experiencing as well for your products? And are you all giving some additional discounts or incentives to push through sales? Go ahead.
Morning, Nigel. Thank you for having me. Yes, I think post-festive, which is post-October, there has been a slowdown in demand. So we have seen a softer November and December in terms of demand. And let me just split that a little for you. Between rural and urban, or before that, obviously, we've all been saying that premium is doing better than the rest of the categories. And typically, in the last few months, we've seen that rural has been doing fairly weak. In fact, not just last few months, but the last few quarters. My belief has always been, and I've always said, that we look at the FMCG sector very closely, because I think that's where you need to see the demand bounce back first. And then we think in a month or two after that, we should see demand bounce back for us. I don't know if it's a little early to call out the good news or green shoots, but recent commentary, at least in the last couple of weeks, from FMCG has been that they're starting to see a little bounce back of rural demand. If that's the case, I'd be happy for that. My guess was we had a quarter away from that, but if that's starting to happen, that's good news according to me.
Okay.
And sorry, on your second question on the discounts, yes, I think in these times, I would like to have maintained the prices for the sake of earning back the margins that we had lost a bit of due to commodity pressure. But we've had to, take on some price decisions to at least maintain our revenues and cater to demand pressure.
Hi, Anuj. Good morning. Just to continue with what Nigel asked you, is there any difference in terms of premium products demand and not so premium or mass product demand? Also, this lull after a festive season, is it typical of pre-COVID year, or is it particularly more galling or more intense this time around?
So the second question first, Lata, it is more intense. When we're saying lull, of course, festive sees a certain spike, so I'm putting that aside. But, we have seen a fairly, I don't want to use the word sharp, but it has been a much more softer demand post-festive than typically one encounters. Coming back to the previous question on the premium versus mass, I think we overplay the premium definition. In premium, we have to understand in a large-scale business, it's a very small sliver of the total portfolio. So you do need the mass to really kick in, and therefore this premium working is not good enough for most of us as an industry, which you see. One aberration I'll call out right now, we've been observing that. I'll just give you the data. I am not able to get around to what that implies, is that, this season has been soft for water heaters. And mind you, water heaters are not that linked to actual winter setting in. So this should have been a good quarter for water heaters, but that's been slightly soft. And water heaters are a slightly more urban product. You don't see that so much in rural India. On the flip side, induction cooktops have been doing fairly decently, and we've seen growth in that, which is a more rural product. So that seems to me an aberration from the wider trend that we're seeing of urban demand being better than rural. But if I just call out these two product categories, they are kind of contrarian signals. And yet, this is just a data point. It's a little early to read too much into that.
Anuj, hi, morning. Isn't a sort of sector like paints perhaps a better kind of indication of when things pick up in your sector as well? I mean, or you think FMCG, as you've been pointing out, when you joined us in December as well, you'd said that's an early indication of whether things are starting to turn. So just trying to understand, isn't, why would paints as a sector give a good indication?
So Prashant, I'm not so sure, to be honest. I've not studied paints as much in terms of correlation. I did look at housing sales, and I tell you, housing sales in our industry does not have a correlation, unlike usual assumptions. So in general, I've seen just pure consumer demand having a good, what should I say, FMCG is a much better metric that we've found relevant for us.
Right. Just Anuj, when we say premium in your, say for example, in the fans category, what constitutes as premium? Above what price point?
Different companies take different price points, but I would say anything above 2,500 or 3,000.
Okay,
and therefore I call that out. Premium is what should I say? When you're talking large white goods, premium has a very different definition when we talk smaller appliances like ours. For us, if you're asking, our premium fans about 19% of our total fans sales.
Okay, and Anuj, that contribution of premium fans has increased, I think, from mid-single digits to around that 19-20% odd. Where do you see this contribution headed? You all have been, pushing on that front as well. So I ask you, and in turn, what about you'll have to spend more. So what about the advertising cost as a percentage of sales? How does that work?
So firstly, yes, for us, we were very under-indexed from premium segments. So we are at 6%, which is up to 19%. I don't know what the final number would be. I'd be happy for it to be at 30% plus. On the advertising front, yes, we have spent more. Q3, we had higher expenses, but that's also because we've done a brand repositioning, brand relaunch for Bajaj as a Built for Life platform. So that's really the reason. That's more not really a tactical call, but the more strategic thing. On a longer term basis, we are refreshing our brand to make it more aspirational and focused and targeted. Going forward, we've always said we will maintain healthy brand spends. And those will not be short-term opportunistic, increases or decreases based on a quarter targets, because, I think that's far more strategic for us.
And despite this, additional spend, you still hang on to that target of double-digit margins in 18%, right?
18%? I don't think
in 18 months. 18 months. Apologies. The double-digit margins
yes.
in 18 months.
I would hope so, unless, something else changes dramatically, particularly commodities. Let me call out commodities. We've had a good run 6 months, where right from April to November, it has been coming down. December, you started to see it slightly inch up, aluminum, copper, stainless steel, etc. But not signs of worry so far. I would be hopeful that, this is something you can easily absorb.
Okay. And any update at all on the demerging of the engineering and project business?
Yes. So, the SEBI approval came through a few weeks ago. We've had the NCLT application that's filed. We, on the cusp of the NCLT hearing and confirmation. We will shortly announce the next steps, particularly when we call for shareholder meeting post NCLT approval.
So that's FY23. You're through in FY23.
So this calendar year 23, next 2 months, we are hopeful of getting that process completed.
All right. Anuj, you're out of time, but it was a useful conversation. Thank you very much for joining us. Have a fabulous 2023.
Thank you very much.
Okay, and we now shift to what is going to dominate January, besides, of course, pre-budget discussions, earnings season. The Q3 earnings season kick-starts with TCS on the 9th, that's Monday, and Infosys and HCL Tech on 12th, and Wipro on the 13th. The big question is, the slowdown easing, or is it worsening? And is a slowdown priced in after the 30% underperformance of these stocks last year? Rima is joining in with the key expectations. Rima.
Thanks so much for that. So let's start off by telling our viewers what we can learn and hope to learn in this quarter's results and commentary. Now, Q3 is typically a seasonally soft quarter. But this quarter, growth rates will further moderate given the higher furloughs. Remember, HCL Tech has already highlighted higher furloughs in 3 verticals: high-tech, BFSI and telecom. As you can see from the CNBC-TV18 estimates, the top 5 IT companies are expected to report a growth rate ranging from 0.5% up to 3.5%. But this is much lower than the revenue growth posted by the same companies in December of last year, where growth rates went up to more than 6%. So that's the first point. Despite December being a seasonally weak quarter, growth rates are going to slow down. But what we want to hear from the management is to understand the future demand. So in that, watch whether the furloughs will continue into Q4 as well. Secondly, how are the tech budgets? If the tech budgets are flat, and if they're not growing, and if large deals are absent, can the companies hope to see double-digit growth next year? Also, is there a moderation in the deal win outlook? What about pricing? Do you see any kind of pricing pressure? And finally, the hiring numbers, which in a way are seen by the market as a proxy for future demand. Let's move on and not talk about the margins. Now, according to the CNBC-TV18 poll, margins are expected to improve for the second quarter in a row. The drivers are INR depreciation and secondly, declining attrition. Now, TCS's margins are expected to rise about 70 basis points to 24.7%. For Infosys, margin expansion is seen about 30 to 40 basis points. Now, while margins are improving for the second consecutive quarter, the point made by IT bears is that margins are still significantly off compared to the peak levels that the companies hit post-COVID. Remember, in the immediate aftermath of COVID, IT companies had cut back on salary costs. Travel costs were absolutely zero, and that resulted in margins surging. So the question on margins is there scope to improve margins from here on, given that attrition is on a declining trend? Or will lower growth offset any kind of margin improvement, because you need operating leverage for margins to expand from here on? Now let's move on then to the other crucial bit, and that's guidance. Now, Infosys and HCL Tech are expected to retain their revenue and their margin guidance. For HCL Tech, remember, just in the month of December, the company had tweaked its guidance. They had said that growth will be at the lower end of their guided revenue band. So don't expect any kind of change. Wipro gives you a quarterly guidance, and next quarter's guidance, that's Q4 FY23, is likely to be muted, and the management could just continue to be conservative, 0 to 2%. But as we've been saying, the question really is on future demand, FY24, FY25. And here the results are unlikely to give you any strong quantitative signal on what the future outlook and growth could look like. It's too early. Perhaps we'll have to wait for April to May period. And finally, a word on the stock price and valuations. Now, the Nifty IT underperformed the markets last year. Last year, the Nifty IT index was down 25%, underperforming the Nifty by 30%, because the Nifty was up 5%. But the Nifty IT index has underperformed the markets only once in the last 15 years consecutively, which means 2 back-to-back years of a decline. So will this support a trend reversal in CY23? And finally, what about the margins? These are where the current margins, valuations of the IT companies are. Valuations have corrected, but they're still at a premium compared to the historical average levels. So will we see a valuation downgrade from here on? Will we see derating? And that's going to be a question that the street will be watching. Back to you.
Okay, thank you very much for that, Rima. Let's now invite our guest. We have Apurva Prasad, the research analyst of IT sector at HDFC Securities, joining us. Apurva, good morning. Thank you very much for joining us. When you heard Rima's presentation, what is your sense? Are furloughs going to be longer? Will it impact Q4 as well? What's your sense? Is the street still overestimating the Q3 numbers?
So growth is certainly moderating. I mean, if you're looking at how the growth trajectory is going to be, from a peak of 18-19% that the companies did about in FY22, it comes off to 13.5% growth rate, and that comes off to about 8.5% growth for FY24. So there is that moderation. The furlough impact is higher. The context also is that the impact was not as high, last time around, which is why you had much stronger Q3. So it's to that extent it is normalizing, and which is what we're talking about. So we do see growth normalizing, and so is the case for valuation. So valuations are also trending downwards. They're off from 3 standard deviation or over 3 standard deviation, now more like 1 standard deviation. That's sort of where it stands. So the macro backdrop is obviously added to the uncertainty element. And I mean, the way you look at it, typically the businesses have about 80% visibility onto revenue and growth for next year. So that number is currently tracking a lot lower. The companies that have indicated that if typically you would have 80% visibility for the year ahead, it's running probably more like 70% visibility. So that's the level of uncertainty that one's looking at. However, despite that, if you look from what's happened on the operational side, because of this lead lag factor between growth moderation and the impact on cost of delivery, which has been normalizing, what it's going to do is the operational improvement is going to improve the profit growth trajectory. So if you look at profit growth, how that played out for FY23 and what that does in FY24, that's going to go back to double digits. So I think that's the positive thing in it.
Apurva, do you expect companies to kind of meaningfully shift when they report and then we hear the commentary, etc.? Your kind of how you'd approach these stocks, these companies. I mean, for viewers, the basic question is how should they, should they buy these stocks now? We spoke with a fund manager like S. Narain who said you should buy into this US recession, buy Indian IT services stocks as they go down systematically. So how do you expect that to change the investment approach in this space?
Prashant. So what we're saying is we do have a constructive outlook on the sector, but what we're saying is the return expectation should be modest at best. We expect about double-digit type of returns, and one has to have a pecking order at this. It has to be a lot more stock specific, which is what we have called out in our recent note too. So yes, I think the outlook continues to be positive, but one would have to be a lot more selective.
In what way, if you can explain, Apurva? You said you have to have a pecking order, a lot more selective. Can you explain?
Yeah, right. So if you look at the factors which is leading on to our pecking order or the preference, in our pecking order, some of the factors that we look at is the magnitude of growth. So growth leaders within the relative sub-segments, whether it is within the tier 1 or mid-tier or within some of the vertical sub-segments. That's one. Number two, the visibility of near-term delivery. That's another important factor. And wherever there are positive catalysts available. So these are some of the factors. And I think if I look at which are the companies that tick some of the boxes here, within the tier 1 IT, we do prefer Infosys. And within the mid-tier companies, we prefer Persistent Systems.
Okay. You expect margins to be better since attrition is down?
Yes, Lata, so that's happening. So like I was saying earlier, the lead lag between growth moderating and cost coming up. So take, for example, subcontracting, that number which had shot up significantly in a high demand environment, that is coming off. So the scope for that to improve exists and you're behind that wage hike period. And so I think a lot of levers are there in the market. That's what's going to propel the profit growth. The profit growth from an FY24 standpoint is actually a lot better than FY23.
Okay. Now, you answered Prashant in detail, but are we at least towards the end of the IT down cycle?
Yeah, so I think the performance is going to be more linked to the earnings growth trajectory. If you just map out over the past year what's happened, you had valuations that have come off from over 30x to more like 21, 22x currently. And if you really look back, what's the earnings downgrade versus PE derating? It's largely been PE derating. Within the tier 1 pack, you've had some companies where there was a certain component of earnings cut. But if you split that with mid-tiers have actually seen earnings upgrade. And so it's really more a question of how much of the multiple is a function of the outlook for the next few quarters. And I think in that context, I think PE multiples are probably capped at one standard deviation. That's where they are, and that's what I meant by the stock performance is going to be a function of earnings growth.
Okay. Well, we will see how things happen and we will touch base with you when those numbers come. Thank you very much, Apurva Prasad, for joining us and helping us understand what to expect from the IT companies. Quick break and then we'll have our technical experts, Mitesh Thakkar, join us for fresh technical trades, and we'll also have Manisha join.
All right, welcome back. You got the market, which is now down. I mean, it's done a full round trip since the morning. We started lower, made a high at about 940 or so, and then we've seen a sharp downtick to where we are now, which is at we're down about 34 odd points or so. Down from the opening levels as well. 17,962 is where we are trading at now. What should you be doing in terms of specific trades? Mitesh is with us for exactly that. Mitesh, what would you do?
Prashant, the market is kind of tapered off, but I still have two buy calls. ITC is on the buying list. Keep a stop at 331 here. and a target of 345 to about 348 on the upside can be looked at. And I heard Nigel mentioning HDFC Life. That's also given a good breakout and seeing continuation. So that's a buy as well. Keep a stop at 605. Look for targets of around 635 to begin with.
Okay. Thank you very much, Mitesh, for joining us with your 10 a.m. trades. We have to look at the commodity markets. A lot of cues coming from there. Manisha Gupta is waiting by. Manisha, what are you tracking today?
Lata, thank you for that. I'm looking at the metals as a sector because overnight we've seen some strong gains come in for this. So whether it has been about copper, aluminum or nickel, all these three major metals gained anywhere between 1 to 1.5% in the overnight markets, and Asia really seems to be holding those gains. Well, three major factors to watch out here. One, China says that they are going to reopen the border to Hong Kong on 8th of Jan. That is supportive. Also, China's Guangzhou province, which actually is the manufacturing capital of the country, says that they are starting 1,722 projects there, and they are looking at nearly $645 million of infrastructure push into that one. And then the Chinese Lunar New Year holidays start from 23rd to 27th of Jan. That 1 week is shut for China. So there could be some restocking ahead of that as well. And that perhaps is supportive for the metal prices there. Take a look at the copper prices. And we have seen a very smart rebound come in for this one. From its 2-month lows, we've seen a smart gain up. And after 1.5% of gains yesterday, nearly a percentage point of a run up in case of copper prices. Aluminum is trending 0.5% on the higher side as well. We have been constantly talking about the weak inventories on LME and Shanghai. Well, that is something that the markets also seem to be sucking in on. Europe, as of now, has lost 1.4 million tons of aluminum production because of production cuts, with the expectation that we could be looking at the same scenario playing out in the first quarter of 2023. Also, 1 million ton of aluminum from Russia also is now being pushed to Asia instead of Europe, and that market field will have a fragmented and a very uneven market, and that could be supportive for prices. The concerns really come in from the interest rates, which are not very supportive of the strong demand, and is the reason markets feel that current gains perhaps may not be sustainable. There also is a view about the weak economic data that we've seen in sense of manufacturing numbers from China and US, and that could be weak. But industry expects the metal demand to start picking up by the end of first quarter. So there are good restocking levels coming in right now. There is some concern when you look at the premium or the discount that we are looking at in the spot markets right now. That has declined anywhere between 50 to 60%. And then for today, it's going to be the US non-farm payroll data, which the markets clearly have factored in already. So for this week now, the first 2 days were on the weaker side, but the last 3 days for the metals have been stronger. So we seem to be closing the first week of 2023 on a positive note for aluminum, copper, zinc, all of those three metals.
Manisha, thank you very much for that. The big one jobs number later today around US market opening time. The Nifty, as I said, is down about 30 points, but just a few names before we take a break. Coal India is the top volume-led loser, 2.5% down on Coal India, if you can have that name up. IndusInd Bank was nowhere in the mix. It's down 2%, 1192 on IndusInd. I mentioned GIC RE, which is down 4. I noticed New India Assurance as well, which is down about 3%, 131 on New India Assurance. Cochin Shipyard is coming up with a 2% cut. There is Schneider at 179 or so, which is down 4%. It's got volumes, and that's why I'm mentioning it. And there are these financial names, right? I mean, I mentioned IndusInd, but look at LIC Housing, UCO Bank, AU Bank, South Indian Bank. These are all down between 2 and 3.5% at this point in time. Advanced decline, started lower, swung into the green, is now down again. Separated by about 200 odd names, that's it. But it's in favor of declines now. Nigel.
Just one point on Coal India. The problem is that the wage hike has come about, but we're getting into an election year. For the last many years, if there's a wage hike, it gets passed on. There's an FSA price hike. The problem is now getting to an election year. So the FSA price increase may be met with some opposition, point number one. Point number two, the other part of their sales, which is profitable, is the e-auction sales. Global coal prices are falling, so that's what could put pressure on e-auction prices as well. So FSA pricing increase may not come about. E-auction prices could be under some pressure. Just want to make that point out to our viewers.
So a bit of a worry on Coal India margins. Yeah. Okay, we have to take a quick break on that note, and thereafter we're going to be discussing the Indian economy, the Asian economy. There are significant new engines, new factors in terms of China beginning to resume near normal activity. What does all that mean for the Indian economy? Chetan Ahya of Morgan Stanley will be joining.